The house edge is not the business. You buy a casino. The doors open. Hundreds of machines begin taking wages. Unlike a restaurant, the product never runs out. The same seat can be sold again and again. Mathematically, the customer is expected to lose. It sounds almost unfair. You own the building, you set the games, and probability works for you, yet casinos still go bankrupt. The house edge and the owner's profit are not the same thing. The house edge works only across enough wages, customers, and time. The bank payment, payroll, insurance bill, and gaming tax arrive on schedule whether the roulette wheel is busy or silent. A casino appears to sell gambling. In reality, the owner manages a regulated cash operation, a loyalty database, and an expensive building that must create traffic every day. The owner's first wager is made before any customer arrives. The price of entry. At the smallest end, some jurisdictions allow limited machines inside another business. Nevada treats 15 or fewer slots as a restricted operation when gaming is incidental to the main business. That is not a full casino. A non-restricted property needs licensed owners and executives, approved games, surveillance, secure cash handling, compliance staff, a casino cage, trained employees, and enough working capital to pay jackpots and survive slow periods. The slot machines are not the expensive part. The expensive part is building a destination around them, financing it for years, and convincing regulators that everyone behind the project is suitable to own it. A regional casino hotel may require hundreds of millions of dollars. Full House Resorts originally budgeted about $250 million for its Chemonix project in Colorado. Resorts World Las Vegas reportedly cost about $4.3 billion. Nevada's 2025 gaming abstract covered 305 larger casinos with at least $1 million in annual gaming revenue. Together, they reported about $90.8 billion in assets. Median total revenue was about $8.5 million. The average exceeded $101 million. A few enormous resorts pull that average upward. Most owners are buying a local entertainment business dependent on location, repeat customers, and financing terms. Sometimes the operator owns the property. Increasingly, a real estate company owns the land and building, while the casino operator signs a triple net lease and pays rent, taxes, insurance, utilities, and maintenance. The sign outside and the landlord's name may be completely different. Owning a casino brand does not always mean owning the building. One company can run the games and rooms, while another collects rent from the property for decades. Where the money actually comes from. Gaming win is money wagered minus money paid back, adjusted for promotions and accounting items. The casino does not keep every dollar inserted into a machine. At MGM's Las Vegas Strip resorts in 2025, players put roughly $24.6 billion through slots. MGM's slot win was about $2.3 billion, or 9.4%. At tables, players bought in for about $6.1 billion, and the properties won about $1.5 billion. Gaming was only part of the resort. MGM's Strip properties generated about $8.4 billion in total net revenue. Casino revenue was roughly $2 billion. Rooms produced about $2.9 billion, food and beverage about $2.3 billion, and other activities about $1.3 billion. The gaming floor is often the magnet, not the entire machine. A discounted room can attract a gambler. A concert fills the hotel. A convention places thousands of expense accounts near restaurants, bars, tables, and shops. Loyalty programs record who visits, what they play, and which offer may bring them back profitably. The most valuable asset may not be the roulette wheel. It may be the customer file revealing who visits on Tuesdays, who books suites, and who returns when offered a $40 dinner. Scale lets operators spread marketing across properties and move customers between resorts. Premium rooms, conventions, and nightlife extend each visit. A well-structured balance sheet gives probability time to work. Then the broader building sends its bill. The cost the public rarely sees. Nevada's larger casinos reported $11.2 billion of gaming revenue in fiscal 2025 and about $6.7 billion of casino departmental income before wider property overhead. Across those properties, interest expense was about $2.6 billion. Depreciation and amortization exceeded $2.5 billion. Energy expense was about $381 million. Total revenue reached $30.8 billion, yet income before federal taxes and extraordinary items was approximately $1.7 billion, or 5.5%. The casino floor can look wonderfully profitable, while the company behind it is being crushed by rent, interest, depreciation, and the cost of keeping an enormous building open 24 hours a day. Taxes can transform the model. Nevada's top monthly gaming tax rate is 6.75% above its threshold. Pennsylvania taxes electronic gaming device revenue at 55%. The same slot machine can sit inside two very different businesses after crossing a state line. Complimentary rooms, meals, drinks, free play, and casino hosts are customer acquisition costs. Offer too little and the customer leaves. Offer too much and revenue never becomes profit. The deepest risk is fixed obligation. MGM disclosed roughly $2.3 billion of triple net lease expense in 2025 and about $1.8 billion in required annual cash rent under major lease agreements with escalators. The operator also carries most property costs. Probability may favor the house, but the landlord does not wait for probability. Rent is due after a lucky month, an unlucky month, a recession, or a week when half the hotel rooms remain empty. This is why apparently successful casinos fail. Revenue moves. Debt and rent do not. The $2.4 billion warning. Revel was built to redefine Atlantic City, a glass beachfront resort with luxury rooms, restaurants, nightlife, and a vast casino floor. It opened in April 2012 after costing about $2.4 billion. The theory was simple: build something spectacular, attract premium customers, and take market share from older properties. Yet Atlantic City already faced regional competition, and Revel struggled to generate enough profitable traffic while carrying an enormous financial burden. Less than a year after opening, Revel entered bankruptcy. It emerged in May 2013 after lenders converted debt into ownership and removed more than $1 billion of debt. Debt was removed, lenders became owners, and the resort received another chance. Yet changing the balance sheet could not instantly create the customer demand the building required. By the second quarter of 2014, Revel's regulatory filing showed the problem. During the 3 months ending June, it generated about $48.2 million in net revenue, while costs and expenses reached about $72.6 million. Its operating loss was roughly $31.6 million. External interest added another $14.2 million. Revel filed for bankruptcy again in June and closed that September, just over 2 years after opening. The property that cost about $2.4 billion was ultimately purchased out of bankruptcy for $82 million. Revel did not lose because blackjack stopped favoring the house. It lost because the property could not produce enough profitable visits to support the building and the financial claims attached to it. A beautiful casino is not demand. A crowded weekend is not durable cash flow. The physical building can remain almost unchanged while its financial value collapses. The new casino and the owner's outcome. The industry is splitting. Physical casinos are becoming broader entertainment platforms, while gambling itself moves onto phones. In 2025, regulated U.S. commercial gaming revenue reached about $78.7 billion. Traditional casino gaming produced roughly $50.9 billion. Sports betting reached about $17 billion, while online casino gaming reached about $10.7 billion and grew far faster than land-based gaming. The casino's newest competitor is not always another building. It is a screen in the customer's pocket, offering hundreds of games without parking, hotel rooms, marble floors, or a 30-year lease. Strong physical operators sell what a phone cannot: concerts, conventions, restaurants, social energy, luxury rooms, and a complete destination. Vulnerable operators depend on an aging gaming floor while labor, maintenance, and financing costs rise. Consider a hypothetical regional casino generating $120 million annually. Suppose direct operations consume $78 million, leaving $42 million before major rent, debt service, maintenance investment, and corporate costs. If those fixed demands total $31 million, about $11 million remains before tax. Now revenue falls 15% to $102 million. Staffing, security, compliance, utilities, and maintenance cannot fall equally fast, so operating costs decline only to $72 million. cash flow falls to $30 million. The same $31 million of fixed obligations creates a loss. In a strong year, leverage makes the owner look brilliant. In a weak year, the same leverage collects the building's cash before the owner receives anything. The game is stable, the capital structure is not. A strong owner controls positioning, service, promotions, staffing, amenities, technology, and cost discipline. The owner cannot fully control tourism, competition, regulation, taxes, credit markets. Final thesis: owning a casino can be extraordinary for operators with patient capital, an attractive market, disciplined promotions, a strong loyalty system, and enough non-gaming demand to keep the property productive. It can be disastrous for owners who confuse mathematical advantage with financial safety. A casino does not become valuable because customers are expected to lose. It becomes valuable when enough people repeatedly choose to spend time there, while the owner survives long enough for probability to become cash flow. The visible product is gambling. The deeper product is a controlled environment, turning attention, time, data, hospitality, and statistical advantage into repeat spending. The house may win each game in the long run. The owner only wins if the building can afford to stay in the game.